Right. So we were talking about Sensex. So some key facts. It was launched on January 1st, 1986. Base year in value was 1978 to 79. Between 1978 79, this was the base year. It was valued at 100 rupees. Number of constituents, 30 large cap companies. Latest value is, this is points. This is 83,300 points. Now, composition and methodology. The Sensex is a free float market capitalization weighted index, meaning each company's weight depends on its market value adjusted for the shares available for trading. Now, constituents are reviewed periodically to ensure the index reflects the performance of key sectors, including banking, IT, energy, and consumer goods. Representative stocks include Reliance Industries, HDFC Bank, Infosys, and TCS, Tata Consultancy Services. Right. Now we can move on to our next topic here. That is basic investment order. Very important for India. If you earn salary, follow this order. We should definitely have an emergency fund in which we basically would be wanting to consider this the next 6 months expenses. Second is health insurance. Third is term insurance. Then fourth is start SIP in an index fund. Then learn stocks. Then maybe real estate and then other assets. So most Indians do real estate first, which is the wrong order. You should start with an emergency fund. Now, where to invest? Apps in India, you need a demat account and a mutual fund app. So very common platforms are Zerodha, Grow, Upstocks, and Angel One. So Grow is the easiest, and I will be starting investing on Grow myself while learning through different sources. And I'm sharing my knowledge here as well, so that I can learn as well as share all the things that I've learned here. Now, simple beginner investment strategy. So if salary starts, example monthly salary is 70,000. So do this: spend 40,000, save 30,000, invest from that 30,000, invest 15,000 in an SIP index fund, 5,000 in flexi cap fund, 5,000 in debt fund, and 5,000 direct stocks for later. Now, what are the golden rules of investing? Remember these forever. Start early, invest every single month. Don't try to time the market. Index funds are best for beginners. Don't buy stocks based on tips. Invest for long term, that is around more than 10 years. Compounding needs time. Avoid credit card debt. Increase SIP when salary increases, and patience leads to wealth. Now, one line summary of everything: earn, save, invest in SIP, stay invested for 15 to 20 years, you will get to wealth. Now, I told it to tell me in bullet points and define all terms. So, core terms are: income is the money you earn, expense is money you spend, savings is income minus expenses. Asset is something that increases value or generates income. Liability is something that costs money or decreases your wealth. Net worth is assets minus liabilities. Cash flow is the money coming in versus going out. Inflation is increase in prices over time that reduces purchasing power. Wealth is assets that generate income or appreciate. For example, if inflation is 6% and your savings account gives 3%, you are losing money in real terms. Now, banking and saving instruments in India. So we have savings account, bank account with interest close to 2 to 4%. FD is around 6%. Lump sum deposit for fixed time. Recurring deposit, monthly deposit like SIP, but it has a fixed interest rate. PPF is public provident fund. It is a government scheme for 15 years and tax free. EPF is employee provident fund (PF), retirement savings for salaried employees, and emergency fund is savings equal to 6 months expenses. Now, investment terms. So return is basically the profit that you get from investment. Then we have ROI, that is the return on investment, which is the percentage profit. Then you have risk, that is chance of losing money. Volatility is how much the prices are moving up or down based on the market trends. Liquidity is how easily you can convert to cash, that is liquid money. Investment horizon is how long you plan to invest. Compounding is earning returns on returns. Diversification is investing in many assets to reduce your risk. And portfolio is all your investments combined. And asset allocation is how you divide money between equity, debt, and gold, etc. Now, stock market terms we will be discussing in the next video.